Did you commit to another CPA review course that just isn't aligned with how you learn? Well, spilled milk, baby. In the world of accounting, only one figure matters, and that's the bottom line. So by investing in Universal CPA Review, you're investing in yourself, and we promise to do everything in our power to get you the ROI that you're looking for by obtaining your CPA license. We know that purchasing a CPA review course is an investment, and we also know that spending all that money on a program that hasn't worked out sucks, and we want to soften that blow. Our Spilled Milk program will allow you to commit to Universal's Visual Learning CPA Review program at a steep discount. So reach out to info@universalcpareview.com to learn more about our program and what discounts you qualify for. Okay, so as we mentioned, when it comes to bonds, there are two components that are being reported in the financial statements. Yes, obviously the bond itself is going to get reported as a long-term liability. But everything we just talked about regarding the bond being issued at a price that is greater than or less than its face value is also something we need to consider. Right, that difference is what is being reported as either a premium or a discount that also needs to be reported. Okay, so the carrying value, aka the net present value of the bond itself, is going to get reported as that long-term liability in the balance sheet. But think of it this way. The face value, right, that par value, is the net amount that needs to be presented in the balance sheet. And the way that that's going to get presented is by presenting that discount or that premium separately as a valuation account in the balance sheet. Okay, so let's say that, for example, the $1 million bond is getting presented at 0.98. That means that the bond is getting issued at $980,000. Okay, so the $20,000 represents the discount. And that $20,000 is that separate amount that is getting reported in the balance sheet. If it was issued at 1.02, the $20,000 premium would get presented separately in the balance sheet under that circumstance. Okay, so the next topic is extremely important come exam day, and that topic is the amortization of the bond discount or the bond premium. Right, like we said, similar to tangible fixed assets getting depreciated over the useful life of that asset, and even more similarly, how intangible assets are getting amortized, we're going to be amortizing the bond discount or the bond premium as well. So ultimately, it's how we amortize this bond discount or that bond premium that the exam is really going to hone in on. And the way we do this is by applying what is referred to as the effective interest method. Okay, so we're going to consider the effective interest method as the circle of life, right? Hakuna matata. And when you think of the circle of life, you're thinking of this 5-step approach. Okay, so if you think of this 5-step approach every single time, you're going to give yourself a great chance at getting these questions right. Okay, and when it comes to the FAR exam, you must always pay extra close attention to the dates in the given questions. All right, when I say that, I'm specifically talking about this situation right here. All right, so as previously mentioned, we're ultimately focused on two rates, both the stated rate and the market rate. And even more importantly, we're going to be focused on the interest payment periods on this bond, right? Think of the bond as a bond contract. We have an investor and a borrower. Both of these parties are writing up this contract. And they're saying, okay, this is how much we're going to lend you. This is how much you're going to be paying us back. And this is when you're going to be paying us back. And very frequently, what you're going to see, not only in the real world, but also on the CPA exam, is that the bond will be paid back not only annually, but it can also be paid back semi-annually, could be paid back quarterly, or even monthly. Okay, so very common to see semi-annual interest payments on the CPA exam. So we got to be on the lookout for that. Okay, so let's dig right into it. Okay, so when it comes to the effective interest method, as we said, we have a 5-step approach. So this is going to be our mental map. In step 1, we're going to calculate the beginning carrying value of the bond. This can be thought of as the net present value of the bond. It can also be thought of as the initial issuance price of the bond. This is not the par value of the bond. So as we previously talked about, we could calculate this by taking the present value factors and multiplying them by the face value of the bond and the periodic interest payments. All right, but as we also mentioned, they might just give you a situation where it's the face value of the bond is issued at 1.02, or the face value of the bond is issued at 0.98. It's that initial issuance price that is going to be considered the beginning carrying value of the bond. So in step 2, once we have determined the beginning carrying value of the bond, we can now calculate the periodic interest expense. Remember, this is the expense that is getting reported on the income statement. It's different from the periodic interest payment itself. Okay, so depending on who we're talking about, it could be the periodic interest expense or the periodic interest revenue. All right, so for the sake of this example, we're going to consider it the periodic interest expense. All right, but be on the lookout for who we're talking about. But long story short, in order to calculate this, we're going to take that beginning carrying value that we previously calculated in step 1, and we're going to multiply it by the market rate. Okay, so keep in mind, if this is a semi-annual interest payment, we're going to be dividing that market rate by 2. If it's a quarterly interest payment, we're going to be dividing it by 4. That multiplied by the beginning carrying value is going to determine our periodic interest expense and or periodic interest revenue. But most important takeaway is for this calculation, we're using the market rate. Got to pay attention to the dates. In step 3, now we're calculating the periodic interest payment. Okay, so now we're going to take the bond's face value, right, that par value, and we're going to multiply it by the stated rate. Okay, so again, if this is a semi-annual interest payment, we're going to divide that stated rate by 2. If it's quarterly, we're going to divide it by 4. But point being, we're going to take the bond's face value, multiply it by the stated rate. And now we could calculate the amortization of the bond discount or the bond premium. Right? That's the whole point of the effective interest method. We're taking that discount or that premium and we're amortizing it like we would any intangible asset. All right, so how are we going to calculate the amortization expense for the current pay period? We're just going to subtract what we calculated in step 2 from what we calculated in step 3. Okay, so if that's a negative amount, the amortization expense is always going to be that absolute value. All right, but for applying it to this step-by-step process, the best way to do it is taking step 2, subtracting it by step 3 to give us our periodic amortization expense. Okay, now that we're in step 5, we're going to now determine the ending carrying value of the bond after this pay period. All we're doing is taking the beginning carrying value of the bond itself, and we're going to be adding that amortization expense that we calculated in step 4. Okay, so that ending carrying value is going to become the beginning carrying value for the next period, right? It's the circle of life, Hakuna Matata. Okay, so taking a look at an example where we're issuing this bond at a discount. Okay, so we know that the bond is issued at $940,288. So that is below the $1 million face value of the bond. So this effective interest method table is going to be your sanctuary. If you know how to plug and chug into this table, you're going to get these questions right every single time. Okay, so the next important takeaway is the different rates, right? The market rate is 14% and the stated rate is 12%. We also know that payments are made semi-annually. Okay, so if you see semi-annually, double underline it, do whatever you need to do on the exam. Super important that you pay attention to the dates. It's going to make or break this calculation. Okay, so we also know that this can be a confirmed discount because the market rate is greater than the stated rate, right? We remember greater market discounts. Okay, so step 1, we're going to determine the beginning carrying value for the period. We already know it's $940,288. Okay, step 2 is determining the interest expense, also known as the interest income, depending on who we're asking. All right, so we're going to take the beginning carrying value and we're going to multiply it by the market rate. But because this is a semi-annual payment, we're going to divide that market rate by 2. So 14% now becomes 7%. Okay, so $940,288 times 7% is going to give us an interest expense / interest income amount of $65,820. Now we could calculate step 3, which is the semi-annual interest payment. We're going to take the $1 million bond and multiply it by 6%. Why 6%? Because the payment is made semi-annual. We're going to take the 12% rate and divide it by 2. Okay, so 6 times $1 million is $60,000. This is the interest payment. Now calculating the amortization expense. This is step 4, right? The whole point of this is to amortize the discount or amortize the premium. In this case, we're amortizing a discount. All we need to do is subtract step 2 by step 3. So we're going to be subtracting the interest expense by the interest payment. $65,820 less $60,000 gives us an amortization expense of $5,820. Okay, so anytime we have a discount, the interest expense / interest income is always going to be greater than the interest payment. Okay, so step 2 is going to be greater than step 3. Okay, so now when calculating step 5, we're just going to add step 1 by step 4. Okay, so 940,288 plus 5,820 gives us an ending carrying value of the bond in the amount of 946,108. That 946,108 becomes our beginning carrying value for the next period. So 946,108 is going to now be multiplied yet again by the 7% market rate, right? That's the semi-annual market rate. So 946,108 times 7% gives us 66,228. All right, the semi-annual interest payment is always going to be the same, right? This isn't going to fluctuate. Only the carrying value is going to fluctuate. So the 1 million is still getting multiplied by the 6%. So 60,000 is now getting reduced by the 66,228. So the amortization expense for the second period is going to be 6,228. Now in determining step 5, yet again, on December 31st, year 1, we're going to be adding 946,108 by 6,228. Okay, so the ending carrying value at the end of 12/31 year 1 is 952,336. Okay, so something to keep in mind is the carrying value is always going to be moving in the direction towards the face value. So if this is issued initially at a discount, we're going to be adding this up towards the face value, right? Just like depreciating a fixed asset, we would be depreciating it all the way down to 0. We're also going to be amortizing the bond discount or the bond premium all the way down to 0. So by the time this process is all said and done, the face value is going to equal the carrying value. Okay, so how would we record this in the financial statements? Well, there's two sides to the story. We have the borrower and we have the investor, right? After all, this is a debt agreement. Okay, so the borrower's initial journal entry would be a debit to cash for the 940,288, right? This is cash coming in from the loan. Okay, so where this is different from the investor side is we would record the discount on the bond payable in the initial journal entry. Okay, so the discount is going to be debited for $59,712. This is the initial unamortized bond discount. Ultimately, this is the amount that is getting amortized. Okay, so the bond payable would be credited for $1 million. On the investor side, the initial journal entry would be a debit to the investment in the bonds for $940,288. The credit would be cash going out the door. Okay, so that would just be that same amount. Okay, so during the first interest payment on July 1st, the borrower would record the bond interest expense for $65,820. Right? This is the amount that is getting paid back. This is an expense to the borrower. Okay, so the credit would be the discount on the bond payable for $5820. Right? This is the amount of the discount that is getting amortized. Right? We previously debited the entire amount. Now that we've amortized this, it's going to get reversed. All right, so we're reversing this slowly but surely. So the credit would be to the discount on the bond payable for $5820, and the credit would be the actual payment itself, right? This is the cash that's going out the door. Always going to be $60,000 in this case. Okay, so for the investor, they're going to record cash for $60,000, right? That's the amount that is received. Okay, so they would record that discount, right? The amount that is getting reversed by the borrower as a debit to investment in bonds. All right, so that's essentially our plug figure. Right, whereas the bond interest revenue, right, because the borrower recorded an expense, this is revenue to the investor, this would be for that same amount, the $65,820. Okay, so same story on December 31st, year 1, right? Bond interest expense for that amount, $66,228. The discount that's getting reversed is $6,228, and the cash that's going out the door is getting credited for $60,000. On the investor side, the cash that's now coming in is still going to be that $60,000. All right, so the investment in the bonds represents that amortization figure, the $6,228, and the bond interest revenue would be $66,228. All right, that can also be considered bond interest income. Okay, so similar story when bonds are issued at a premium. We know now that the stated rate is going to be greater than the market rate. Okay, so we already know that this is going to be issued at a premium because the $1,064,633 is greater than the $1 million face value. But we can confirm this by seeing that the stated rate is greater than the market rate, right? We're thinking greater stated premiums. All right, so same story when applying the effective interest method, only now we're going to be amortizing a premium, not a discount. Okay, so these bonds are going to be issued on January 1st, and the interest payments are going to be made semi-annually. So that means that the rates are going to be divided by 2. So we're going to divide the market rate of 10% by 2, which is going to give us 5%. and we're going to divide the 12% stated rate by 2, which will give us 6%. So when calculating the interest expense to the borrower, we're going to be multiplying $1,064,633 by 5%. That's going to give us $53,232 as their interest expense. Okay, so the interest payment is going to be $60,000. We're just going to take the $1 million and multiply it by the 6%. Okay, so when calculating the amortization expense, we're still going to subtract step 2 by step 3. So $53,232 less $60,000 gives us $6,768. Okay, so this might seem like a negative figure, but it's still going to be reported as that amortization expense when we go through the journal entries. All right, but for the systematic approach that we're applying, it's best to consider it this negative figure, right? Because what we're doing in step 5 is adding step 1 by step 4. So if we're adding $1,064,633 by negative $6,768, the ending carrying value to the bond is going to be $1,057,865. And that becomes our beginning carrying value for the pay period of December 31st, year 1. Okay, so $1,057,865 is once again getting multiplied by the market rate, that 5% because it's semi-annual, which gives us an interest expense of $52,893. Okay, so the interest payment staying the same at $60,000. Now the amortization expense in step 4 is going to be $7,107, right? $52,893 less $60,000. So once again, when determining the carrying value in step 5, we're going to take the $1,057,865 plus the negative $7,107, which gives us an ending carrying value of $1,050,758. Okay, so same story, only now we're going to be bringing this carrying value down, right? We're always amortizing it towards the face value. When it's all said and done, and this amount is amortized all the way down to 0, the carrying value should equate to the face value. Okay, so the journal entries here are going to be similar to the journal entries we talked about under the discount scenario, right? We need to understand the journal entries for the borrower and the investor. So the initial journal entry for the borrower on January 1st would be a debit to cash for the $1,064,633, right? That's the cash that's coming in. Okay, so the bond payable, right, the amount that is owed is $1 million. So the premium on the bond is going to be that plug figure. All right, so it's going to be a credit to $64,633. All right, so if you could first identify the cash that's coming in and the bond payable, we can always plug and chug when it comes to the premium or the discount. On the investor side, we're not going to be recording the premium or the discount in that initial journal entry. Okay, so the debit would be to investment in bonds for the $1,064,633, and they're the ones that are lending the money. So cash is going out the door. All right, and naturally that's for the same amount. Okay, so now looking at the periodic payment journal entries. The bond interest expense for the first period was $53,232. Okay, that's fine. The cash that's going out the door is $60,000. So the difference here is going to be the premium on the bond payable. This is the account that we're recording for the amortization expense. Okay, so that premium on the bond payable is going to be debited. Okay, so the natural interest expense is going to be debited for that $53,000 amount. So we're naturally going to debit the plug figure for the $67.68. On the investor side, we're going to be debiting cash, right? That's the amount that's coming in. They lent the money. This is the amount that they're periodically getting repaid. They're not going to be recording interest expenses here. They're going to be recording bond interest revenue. Okay, so we need to be cognizant of which side they're asking for. Okay, so the bond interest revenue, the amount that is getting earned is $53,232. All right, we're not going to be recording a premium on the investor side. We're just going to be plugging this with investment in bonds. So the investment in bonds account is getting credited for the amortization figure, $6,768. And then finally, on December 31st, same story. Okay, bond interest expense for $52,893 on the borrower side. Cash going out the door is $60,000. The plug figure is getting debited to premium on bonds payable for $7,107. Okay, and on the investor side, cash is going out the door. Okay, so debit to cash for $60,000. We're going to be crediting bond interest revenue that has been earned for $52,893, and we're going to be crediting investment in bonds for $7,107. Okay, so at the end of the day, we need to know how to calculate any of the 5 steps within the effective interest method. So I'm not going to sit here and tell you that any of these steps are more likely to be asked than the other. And the reality is you very well likely could see this table in a task-based simulation. So you got to be ready for each of these steps, and you need to remember the calculations to get there. But let's not forget the ultimate reason for applying the effective interest method, and that's to amortize the bond discount or the bond premium. Right, that's the extra amount that is being presented to net the issuance price, the carrying value, to the face value. So with that being said, they might not ask you for the impact to the carrying value of the bond itself. What they could instead ask is the impact to the carrying value of the unamortized premium or the discount. All right, so think of this as a separate account balance in the balance sheet. And this balance is also going to fluctuate in the same way that the net book value of a tangible fixed asset would fluctuate as it is depreciated. So they might also ask you for the unamortized bond discount or that unamortized bond premium at the end of the amortization period. So this is just another way of saying what is the net book value of the discount or the net book value of the bond premium after it has been amortized. So we're essentially applying the same 5-step approach here. Okay, only the carrying value is not the carrying value of the bond. It's the carrying value of that unamortized portion of the discount or the premium. Okay, so the initial discount or the initial premium is just going to first be calculated as the difference between the bond issuance price and the bond's par value. Step 2 and Step 3 remain the same. We're still determining the interest expense and the interest payment. We're going to be doing that by taking the bond's beginning carrying value, multiplying it by the market rate to get the interest expense, and when determining the bond periodic interest payment, we're going to be taking the face value and multiplying it by the stated rate. Step 4, once again, going to be the same. The interest expense less the interest payment is going to give you the amortization expense, Step 2 minus Step 3. Step 5 is going to be a little bit different, right? Because this impacts the carrying value. We're not talking about the carrying value of the bond anymore. We're talking about the carrying value of the unamortized portion of the discount or the premium. Okay, so that beginning carrying value of the unamortized portion is going to fluctuate based on the amortization expense. That's going to give us the ending carrying value of the unamortized discount or the premium, right? We're going to be adding the amortization expense to the beginning carrying value of that unamortized portion. Okay, so taking a look at a very similar example, this is a discount, okay, and we can confirm that because the market rate is greater than the stated rate, and we also know that it's issued at 9/40/288. Okay, so the initial discount on day 1, right, as of January 1st of the current year, is $59,712. Okay, so same story. Interest expense is going to be the same, $65,820. Interest payment going to be the same, $60,000. The amortization expense for the first period is going to be that same at $5,820. Okay, but the more broader point is that they're not asking for the ending carrying value of the bond itself. They're asking for the unamortized portion of the discount at the end of the first pay period. Okay, so the beginning carrying value of the unamortized discount is $59,712. The amortization expense for the first period is $5,820. Therefore, the ending carrying value is going to be $53,892.